Okay, great. I think we can get into it. Yes, we had a lot of questions from clients about the current market conditions. So we thought we'd have a big picture presentation for clients. As you are all aware, we bottom-up stock pickers, but I think it's also worthwhile to highlight our top-down view of the world. We have access to some of the world's great thought leaders in terms of macroeconomics, and we've seen some interesting data over the last couple of months. And although we are stock pickers, as I mentioned, some of it does present quite an interesting framework for the future. So as we stand today, we see global equities are up 10% in 2023, which is quite encouraging after the decline that we saw last year, where broadly speaking, global equities were down about 20%. When we look to the performance this year, specifically the technology companies where the running has been had, while last year's winners, specifically consumer staple shares, healthcare and energy, have taken a breather. However, investors remain extremely concerned about equity markets, and we see that in many of the surveys that we're going to later show. And the chief concern, I guess, amongst most investors is about the looming recession and also the geopolitical tensions. We wrote quite a good article at the beginning of the year about the looming recession, and I think the comment we always need to make on that and focus on is that there is no correlation between GDP growth and stock market performance, and normally when you tend to find yourself in a recession, that's at the worst possible time in the stock market, and is normally indicative of a fairly good or indicative of a pair of fairly good returns for clients, just because prices have discounted all the bad news already. So we don't get too concerned when people are very negative about any potential recession. And we do think if the US goes into one later this year, it will be fairly shallow. In terms of other events that are top of investors' mind, I think it's also worth bearing in mind that investors always have something to worry about. In the 25 odd years that I've been in financial markets, I remember it first started off with the Asian debt crisis, then the Russian default, then the tech bubble, 9/11, global financial crisis, PIGS, that's Portugal, Ireland, Greece and Spain. You'll remember that in the early 2010s, China, Brexit, COVID, inflation, Russia. So you can see every year or two, and these are the major ones, every year or two there is something that is top of mind for investors, but eventually we always get through these things. So from our point of view, the setup looks positive for equities for the second half of the year, and we're quite encouraged by what we see in front of us. And I think it's always worthwhile remembering when one is looking at a long-term strategic investment plan, is remembering the 5 and 50 rule. And the 5 and 50 rule is quite simple, and it's that if you miss the best 5 performing days in any year, you lose 50% of the return or the performance. And that's quite important, because it just shows the folly of market timing, and it's impossible to know when the best 5 days are going to be. One just needs to be invested in the market. So we remain bullish, and we'll show you why in the charts that follow. So we saw earlier this year there was a banking crisis in the US, and that was specifically caused by interest rates going up 10 times, one of the quickest interest rate hiking cycles we've ever seen, and that caused duress in the banking sector. But we think the crisis there has largely been averted. You can see the share price of JP Morgan on your screen there, and it's almost back to its previous highs, just indicating a level of confidence has returned. Yeah, I do think that there will still be some issues in the banking sector, but I think they will be fairly constrained. We've seen the Fed come in and guarantee depositors, and capitalism has worked, where equity holders and bond holders in banks have basically lost their shirts, and that's the way it should work. Arguably, the banking sector in the US was also due some consolidation. There are a couple of thousand banks in the US, which is far too many. Banks work better when they have scale. I think the world has also changed. So I think a period of ongoing consolidation in US banking is probably positive for the long run as well. And it's quite interesting just looking at the failures of the banks that we've seen this year and putting it in the context of historical failures. And you can see on that table in front of you that 3 of the 4 largest bank failures in history have happened this year. Yet things remain fairly rosy economically, and there hasn't been much stress felt in the system. One of the key determinants for financial markets is, of course, what happens with interest rates. And on that chart, you can see the Fed funds rate currently sitting at around 4.85%. And you can also see on the right-hand side of the chart the scale of those increases. It's been the quickest rate hiking cycle that we've seen in 40 years. And that's, as I alluded to, what's caused the issue in banks. But what we do think this does provide now is it provides a level of comfort and flexibility for the Fed. Should the US economy enter a recession, it gives them the ability to cut interest rates fairly aggressively. Whereas you can see in the 10-year period from 9-year period from 2008 to 2016-17, they didn't have much flexibility because interest rates were at rock bottom already, similarly with the COVID period. This is one of the more interesting charts we've seen over the last couple of months, and one of my colleagues, McKelly, who's based in Brisbane, highlighted this chart to us, and it essentially shows what's happening in one-home family sales, the year-on-year percentage change. That's the white line. Apologies for this slide not being clear. We couldn't get a clearer copy of it, but essentially it's showing that housing prices have come off quite dramatically, but then it's taken the official CPI data, and you can see, and that's the blue line, that line hasn't fallen yet. So we think what we'll see over the next couple of months is that the official housing inflation data will start to fall quite meaningfully, and that'll have a significant impact on inflation. And housing is very important in inflation because it makes up almost a third of that basket. So if housing inflation subsides to the degree that we anticipate, the same holds true for inflation, that we'll continue to see that number move lower. We also show on this slide the official CPI data. You can see that that's come in at 4.9% was the last print. It's clearly turned from the high of 9%, and we think this will fall further over the next couple of months as more and more data just where it becomes evident that prices are falling. And interest rates are very important for investors because this is typically used in the weighted average cost of capital calculations, and simplistically, the lower the cost of capital, the higher the valuations for shares. So it would be very positive for risk assets, specifically equities, if we saw inflation coming down, because that would have an impact on interest rates. The next chart just highlights what's happened in natural gas prices, and you can see in the post the COVID pandemic and the Ukrainian invasion, the prices have come off quite meaningfully, and once again this will start filtering through into the inflation data, and just assist that data in moving lower. Another slide that or another data point that we look at with a lot of interest these days is the Trueflation data. And one of my colleagues highlighted this to me probably about a year ago, and it's been consistently right since then. And one of the structural problems with official inflation data is that it's a lagging indicator. Typically, by the time that data is reported, it's a few months old. We live in a digital age now, and economic data, be it from home sales, car sales, you name it, there is literally data available every single day. And that's what Trueflation attempts to do. It captures daily economic data and plots that into an inflation number, just giving a more realistic picture of where the true inflation number is. And you can see this is at 2.98%, and that's almost 2% below the official inflation data, which is just below 5%. And we see this number moving lower literally every week. I think we looked a week ago and this number was sitting at almost 3.3, so 30 bips lower over a week. So certainly we believe that inflation will traject lower over the next couple of months. One of the other concerns that many investors had was that valuations in the US specifically were excessive and that stocks were expensive. And you can clearly see on this chart that myth is debunked. The blue line plots the historical PE ratio for the S&P 500, and then we plot an average line in blue and then a standard deviation above and below. And you can see from this chart that S&P 500, which is representative of US equities, is trading in line with its long-term average. And certainly some sectors are overvalued, but in the main, shares look fairly valued. We also think that corporate balance sheets are pretty strong at this point in the cycle, and that makes us quite confident in equities. There are some sectors that we do have concerns about, specifically in commercial real estate. Arguably, those properties are still overvalued in the US. I think Jamie Dimon, the CEO of JP Morgan, alluded to that fact a couple of days ago. And the other area we're a little bit concerned about is private equity, where arguably the valuations there also need to be cut a little bit. But we remain positive. We think equities are neither expensive nor cheap, but in terms of where we've invested clients' funds, we're still deriving internal rate of returns of low teens per annum over the next couple of years. Another thing that we've seen that's fairly meaningful over the last couple of months is that earnings revisions for the S&P 500 have bottomed. And what that means is you have a whole lot of analysts going out and projecting forecasts for what they believe companies within the S&P 500 will do for the next year. That was on a downward trajectory, as you can see in that chart, but you can see it has bottomed and increased. So that gives us some confidence that the worst in terms of earnings expectations is over. This chart plots the operating margins of the S&P 500, and it shows that that's trading pretty much in line with its long-term historical average. And we've seen companies be extremely aggressive on this front. And they all probably took a leaf out of Elon Musk's book, where he showed you could run Twitter on half the workforce, yet still operate an efficient platform. So margins have remained protected, and we've seen that in the reporting season that we've just gone through, where the market was expecting earnings to decline by 7%, and they actually came in 5% better. And that was largely on account of the means or the measures by management to reduce costs in their business. Another thing that makes us confident about the year ahead is what we're seeing on the energy front. And at this level, with oil trading at around $75 a barrel, we think that's stimulative for the economy and doesn't present any meaningful headwind at this point. What was also quite restrictive for equities over the last 12 or 18 months was the very strong dollar. We've seen that bull mark ended, and we think this will be positive for risk assets going forward. The strong dollar also had a negative impact on most global companies because these global companies are selling in euros, yen, and the earnings they translated back from those regions were weaker, but that has now reversed. Any presentation isn't complete without probably mentioning something about China, and we've seen post their COVID lockdowns that they're slowly starting to pick up momentum. They are opening up a lot slower than what people anticipated. I think there were expectations that growth would be incredibly robust, but it has been a lot more sedate. But at least it is picking up, and you can see in this chart the GDP forecasts have moved from 4.8% up to 5.7% and are moving higher all the time. One of the charts that makes us most confident is how investors are positioned at the moment. And uniformly, we are finding investors quite negative. And there are a lot of surveys that come across our desk, be it institutional surveys, hedge fund manager surveys, retail investor surveys, derivative trader surveys. And what they all point to is that those investors are negative and either sit with high cash balances, have a lot of put option protection. And the reason why we like this is historically that's proven to be a very good contrarian indicator. And we think if there's any improvement in terms of economic data, or the Fed pauses and then starts cutting rates, investors aren't positioned correctly, and they'll start moving into equities, which will be positive for that asset class. This is another chart which just shows exactly the same thing, and it just shows that the S&P 500 benchmark has the most net short in 12 years. So you can see the blue line there showing that the futures positions is the same as it was just after the global financial crisis. And certainly the news on the ground isn't as severe as it was at that point in time. This is a fascinating table, and it just shows what happens after the Fed has ended its hiking cycle. So I think the last 25 basis point hike we got from the Fed was probably the last. At worst, there might be another one, but it seems quite unlikely. But this point or inflection point historically has been a very good time for equity investors. And historically, when this has happened, the next 12 months have generated a return of 21.8% for investors after the Fed has stopped hiking rates. So for us, the bull case is quite simple. The banking crisis has been averted. The Fed is very likely to pause further rate hikes and is possibly likely to cut later this year. The valuation correction is over. Companies are fairly valued at this stage. We have seen earnings revision bottom out. Inflation is declining. The dollar bull market has ended. Energy costs are stimulative. Pessimism and positioning is offside. Corporates have cut costs quite aggressively. And as we just showed in the last table, stocks tend to perform quite well when the Fed has stopped hiking interest rates. So although we're bullish, we're not naive to some of the risks out there, and things like commercial real estate, private equity valuations, geopolitical concerns, and the constant threat of inflation reemerging do keep us awake at night. But I think on balance, we remain bullish as we move into the second half of the year. We remain excited in terms of the companies that we have invested on behalf of clients. We think collectively they're a group of high quality companies with good growth prospects, and we think they'll generate good returns for clients. Thanks for your time this evening. Just going to see if there are any questions for us on the Q&A. I can't see anything. Yeah, so thanks to everyone for joining the call. If you have any questions, don't hesitate to reach out to me directly.